Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Kroger stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 33 billion market cap. They're trading at $46 a share, and they have 719 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow was high in 2021, close to $4 billion, down to $1.4 billion in 2023. It is up in the trailing 12 months to $2.3 billion. Net income is a profit or loss on the income statement. It's revenue minus expenses. That's also highest in 2021, dropping to $1.7 billion in 2022, up about 40% into 2023, dropping again to $1.9 billion in trailing 12 months. Revenue is a sales for the company, and they have really high revenue. It peaks in 2023 at $148 billion, down a little in trailing 12 months to a little under $148 billion. They're a supermarket, so they have really thin margins. Revenue grew 4% from 2021 to 2022, then 8% the next year, and it's flat in the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $52 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $49 billion. We divide that by 719 million shares. And we get a calculated stock price of $69. They're trading at $46, so they're trading at a 33% discount. It's a buy according to the model. The stock price doesn't really move that much with large grocery store chain. It's not like a big tech company like Meta, where their stock could swing a lot year to year. This company has pretty small swings, but you do get that consistent dividend, which I'm sure is never going to go away. There are 12 companies in the same industry as Kroger, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx, $3.6 billion, double ACI, Albertsons. Most of their CapEx spend is when they buy the real estate for a new store. That gets put onto the balance sheet and depreciated over its useful life. They're a bit leveraged, 1.8. That means for every dollar of equity, they have $1.80 of debt, which is a lot better than the average. Weiss Markets has the best debt-to-equity ratio, 0.1. They pay a nice dividend, 2.4%. Look at Natural Grocers, 9.3%. They generate the most free cash flow out of anybody on this list. You could sum up the rest of the companies, and they're still smaller than Kroger. They're the biggest company on this list by far, nearly triple Albertsons. Their price to book is a little worse than the average, 3.0, that's stock price over book value per share. A decent PE, it is worse than the median average, 17.6. A lot better than Grocery Outlet. A great price to free cash flow, 14.3. Look at Village Supermarket. They have the best price to book, PE and price to free cash flow. I guess people just are not interested in this stock. They have a good price to sales, 0.2. That means their revenue is 5 times their market cap. Well, it's not quite 5 times. It's like 4.5 times. If it's exactly 0.2, it would be exactly 5 times. But I'm sure it's like 0.23 or something like that. They're not really growing that much. Their 5-year annual revenue growth rate is 3%. Ingalls is number 1 at 8%. Let's look at their most recent 10Q for the quarter ending 11/4/2023. We'll start with their income statement. Revenue for the quarter of $34 billion, down a little from last year of $34.2 billion. For the trailing 9 months, revenue of $113 billion. That's also down a little from 2022. Let's see if they give a breakdown of their revenue. Their total sales of products and services in the store is $30 billion. Gasoline sales is $4.1 billion. Their revenue is lower in both categories. Their main sale category is down 0.7%. Fuel is down almost 2%. They have pretty high operating expenses. All the expenses to buy the products to put in the stores. Also advertising, warehousing, transportation. That's $26.5 billion. Operating, general, and administrative, $5.6 billion. Rent, $201 million. And then depreciation, $700 million. So operating profit, $900 million. It is higher than last year of $840 million, so they're more profitable, they're more efficient. Their net profit is $647 million, up from $400 million. So their EPS 89 cents, up from 55 cents. Shares outstanding are up from 716 million to 719 million. Let's take a look at their balance sheet. This is 11/4/2023 versus January 28th, 2023. Current assets, $13.4 billion. Current liabilities, $16.8 billion. So their current ratio is below 1. They may need to add some debt to get through the next 12 months. I wouldn't be too concerned because they're cash flow positive. If they were cash flow negative and at a current ratio below 1, that is a big red flag. They always have a lot of inventory on hand, $10.3 billion. They use FIFO, first in, first out, which is what most companies use, FIFO. I know if you report under IFRS rules, if you're an international company, LIFO is prohibited. You have to use FIFO or average cost. If they did use LIFO, their inventory would be different by $2.3 billion. That's what the LIFO reserve is. Their big asset by far is PP&E, $25 billion, nearly half their asset. A lot of that is the stores they own, also some of the equipment in the stores. They owe $6.8 billion on operating leases, $2.9 billion of goodwill. Total assets $51 billion, up from $49.6 billion. Total liabilities $40 billion. Their big liability is long-term debt, $12 billion. So when you take their assets minus their liabilities, you get their equity, $11.1 billion. They raised $5.7 billion from selling their business. They profited $26 billion from running their business. They buy back lots of stock. They bought back almost $21 billion of their own stock. That's a good way to inflate your stock price. Let's look at the statement of cash flows. The first section is operating cash flow. That was nearly $5 billion. This is for the trailing 9 months. Last year was $3.3 billion. That's how much cash they generate from running their day-to-day business. The reason it's so much higher than net income is because of depreciation and amortization, $2.4 billion. They spent $3 billion of PP&E. They paid back $755 million of debt. They paid out nearly $600 million of dividends, $90 million more than last year. And they bought back $54 million of their own stock. Last year was nearly $1 billion. Let's look at the stock on Simply Wall Street. Its last price, 46, $33 billion market cap, up 1% in the past week, up 3% in the past year. Let's see what they say about the company. Kroger operates as a food and drug retailer in the U.S. The company operates food and drug stores, multi-department stores, marketplace stores, and price impact warehouses. They offer natural and organic food, pharmacies, general merchandise, pet centers, seafood, organic products, apparel, home fashion and furnishings, outdoor living, electronics, automotive products, and toys. They also manufacture and process food products for sale in their supermarkets, also online. They sell fuel at some locations. They were founded in 1883, based in Cincinnati, Ohio. Simply Wall Street is really bullish on this one, $93. They say it's 50% undervalued. 21 analysts priced this stock at $51. They say it's slightly undervalued. Their revenue back in 2020 was $130 billion. The forecast for 2026 is $151 billion. Not much growth over the next few years, but that's how these companies are. They pay their next dividend on March 1st. The ex-dividend date is 2/14, so you have to own the stock before 2/14 to get the dividend. You can see their yield fluctuates quite a bit. It was 1.7% in 2014. It peaked at 2.8% in 2019. And the forecast is 2.8% by 2026. The CEO's annual salary is $1.4 million, total compensation $19 million. His tenure as CEO is 10 years. Lots of insider selling, no buying. About 125,000 insider shares have been sold in the past year. 3/4 of the company is owned by institutions, 17% by the general public, and 7% by public companies. Their biggest shareholder is Vanguard at 11.4%. The king himself, Warren Buffett, Berkshire Hathaway, 7%. Then you can see a lot of different companies, Neuberger Berman, Pacer Advisors, Schwab, Invesco, JP Morgan Asset Management. They employ lots of people. It was 343,000 in 2013. They're currently at 430,000. And the ticker trades in lots of places. The New York Stock Exchange, Deutsche Börse, Xetra, Mexican Bolsa. London Stock Exchange, Euro TLX, Wiener Bourse, Bulgaria, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.